concerned, angry, astonished. There is a fringe element. It's almost entirely in the ETF industry. That's a marketer's dream. A bad industry. This industry became a total marketing business. It became an opportunistic business. It became a business creating expectations on past performance that could never possibly be duplicated in the future. People that have no background in the business, Henry Kaufman calls them financial buccaneers, come into the business with a hot idea, and they want to sell. I won't name any names. They want to sell what's ever hot. And you've read interviews with these managers in Barron's, kind of frightening. And they say, well, I know that Japan and Europe, two of their funds, are currency neutral funds, aren't going to last forever. So we'll think of something else when they fail. Was that the way to be in this business? To market products? I don't even like the word product. I banned it here, actually, years ago, to come back. You used to pay a $5 fine if you ever mentioned it. I didn't think we were manufacturers selling products. I thought we were trustees selling fiduciary services. People would say, that guy is a real sap, and he probably is. But I have an idealistic view of the business. What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year, cumulatively, against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. And when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. We were doing some mathematics, so I was just playing some numbers games. I looked at the growth of exchange-traded funds and traditional index funds in the last decade, roughly, and they were virtually identical. They'd both grown at about 18% a year. And then I looked at the sources of that growth. And the sources of that growth, for the traditional index funds, it was 65% appreciation and 35% new capital coming in. And for ETFs, it was exactly the opposite. 35% appreciation and 65% for capital coming in. You kind of know that from the press. They're very popular. They do all kinds of wild things, which I could talk about for a minute later on. But in any event, I thought, well, wait a minute, there's a message here. If the appreciation is heavily concentrated with traditional index fund, what does that mean about the returns of the two? That the returns of ETFs are considerably lower than the returns from traditional index funds. And you can measure this pretty easily. Mike does it for me. I can't tell you it's easy firsthand, but we go over the data. And it turns out that the traditional index funds have had a return during that period of 7%, 7.1%, and the ETFs have had a return, the average ETF, of 4.7%. That means you had your choice between a 10-year return of roughly 120%. I'm doing a little bit of this off the top of my head, or that's 70%, 110%, 120% from the traditional index funds, and a return of about half that, 65%, from exchange-traded funds. Why doesn't anybody know that? Why is that news? And does nobody care? And the reality is that ETFs are probably the greatest financial innovation of the 21st century. They are probably also the worst investment innovation of the 20th century because people use ETFs badly, and the sponsorship is wild. Salesmen need something to sell, so we throw out more new red meat to be sold. It's a marketing business still, the investment business. It should be much less of a marketing business and much more of a fiduciary business, I think. I know. And it's obvious that trading is your enemy and is the investor's enemy and the broker's friend. I mean, this is not complicated.
Well, of course, I've only been in this business for 57 years, and I have never seen anything like it in my life. I've never seen anything like the amount of speculation that's going on in the market, which is basically twice as much stock trading, twice as much turnover as we had in 1929, the previous high. We have these frequent days. We've had 37 of them in the last year where the market's gone up or down 2% or more. And when I came into this business in 1951, we might have had 3 or 4 days a year like that. 12 times as many wild and woolly days as history would have said. So we've taken the whole focus of market participation in our capitalistic system here in the U.S. From one of investment to one of speculation. And I happen to think that's a tragedy in which the investors are the losers, and which, of course, somebody's a winner. Wall Street wins. They make $650 billion a year in fees and commissions and all that kind of thing, which means that investors lose that much to the market.
How can that be, since I don't believe in factor investing? The answer is pretty easy. I didn't create them to be traded with one another. I created them to be with the growth fund to be bought during your accumulation phase, where you have less taxable income and maybe a little more volatility. And then when you get to the distribution phase of your retirement account, you got more income and a little less volatility. Not very complicated. And I warned investors in 2 consecutive annual reports, don't trade them. And then I said, you know, the most likely thing is that in the long term, both growth and value will have the same return. Well, 25 years later, growth and value funds both had a 9.1% return. You can't get an awful lot closer than that.
Right.
And yet the average investor got, I think, a 7% return, the investor now, not the fund, in the growth fund, and a 5% in the, or 7% in the growth fund, I think, and 5% in the value fund. Something like that. I may have the numbers a little bit off. So investors lagged, and if you accumulate that over 25 years, that lag is enormous. So investors did what I told them not to do. I told them not to do it, Christine, and traded it, and to their own disadvantage. So I feel so funny, as you know, I don't believe in factor funds. I believe factors come and go. I believe that the coming and going of a factor cycle is unpredictable. And that is, most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings, they pay out dividends, they reinvest the earnings in the business. That's where the value is created. You access that value through investing. So then the question is, corporate America's created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom. Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you got a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits.